This simple ETF strategy turns $10,000 into a $4,311 monthly paycheck machine. And most investors are completely missing it. I've tested multiple dividend ETF combinations using real market data through May 2025, and the results shocked even me. One strategy generated 116% returns while paying out almost 8% annually. Another crushed the market with lower fees than a cup of coffee. But the third strategy? It silently builds wealth while most investors are distracted chasing the latest AI stocks. I'm Harry from Harry's Financial Fitness, and today I'll show you exactly how to build 3 powerful dividend ETF portfolios that could completely replace your income, even if you're starting late. In this video, I'll break down the hidden advantage of this 7.98% yield ETF that actually pays you monthly, how Harry turned $500 a month into over $42,000 annual dividend income using just 4 ETFs, why most investors completely miss the true wealth-building power of these dividend combinations. And by the end, I'll reveal the exact ETF strategy that delivered a mind-blowing 505% return while generating steady income. Let's dive in. Most investors think dividend investing means slow, boring returns with barely enough income to notice. The truth? They're looking at individual dividend stocks all wrong. The real problem isn't finding the perfect dividend stock. It's building the perfect dividend ETF combination that balances immediate income, growth potential, and sector diversification. Most people completely miss this, focusing on dividend yield alone instead of total return. So how do you actually build a portfolio that generates serious monthly income, grows itself automatically, and outperforms the market? That's exactly what you'll discover today. I've analyzed 4 powerhouse dividend ETFs that, when combined strategically, create different paths to financial independence. Let's break down each one to see why they work so well for passive income investing. SCHD, the dividend growth champion. First up is SCHD, and let me tell you, this ETF is like the foundation of a house. Skip it, and your entire dividend portfolio could collapse. Why is SCHD so special? For starters, it pays you a juicy 3.91% yield while charging fees so tiny they're basically invisible, just 0.06%. That's like paying 60 cents per $1,000 invested. This ETF is massive. We're talking $69 billion of investor money. That's not just big, that's larger than the GDP of 100 countries. Big. And there's a reason investors are piling in. SCHD has delivered an eye-popping 219% return since inception. Look at the companies: Coca-Cola, Verizon, ConocoPhillips. These aren't just companies, they're cash-generating empires that have been paying their shareholders for decades. It's like getting a raise without having to ask your boss. RDIV, the financial sector powerhouse. Next is RDIV, and this ETF is like that friend who knows where all the money moves. While everyone else is obsessing over tech stocks, RDIV is quietly collecting fat dividend checks from the financial sector, with a solid 4.08% yield. RDIV has nearly doubled investors' money over the past 5 years with an 84% return. And it does this by investing in companies that literally handle money for a living. The top holdings? Best Buy, US Bancorp, Prudential Financial. These companies make money when interest rates rise, when people shop, and when businesses grow. They're like toll booths on the highway of American commerce, collecting fees no matter who's passing through. What I love about RDIV is how it balances SCHD perfectly. When tech stocks struggle, financial stocks often thrive. It's like having insurance on your dividend portfolio. XLE, the energy sector growth driver. XLE is the rocket fuel in our dividend portfolio. This energy sector ETF has exploded 116% higher in just 5 years. That's not a typo. It more than doubled investors' money while still paying a respectable 3.39% yield. The secret? XLE owns the largest energy producers in America. ExxonMobil, 23%, Chevron, 15%, ConocoPhillips, 7%. These companies literally power our entire economy, and they're swimming in cash. While everyone was going crazy for electric vehicle stocks, these energy giants were quietly raising their dividends and buying back massive amounts of their own stock. 1 barrel of oil generates enough profit to fund generous shareholder returns. Yes, XLE can be volatile, but that's exactly what creates the opportunity. When prices dip, You're essentially buying these cash-generating behemoths at a discount. It's like finding premium gasoline at dollar store prices. JEPI, the monthly income machine. JEPI is the income superstar that most investors completely miss. While other ETFs pay quarterly, JEPI deposits money into your account every single month with a massive 7.98% yield. That's almost 4 times what the S&P 500 pays. How does it work? JEPI uses a genius strategy called covered calls that generates extra income from its holdings like Visa, MasterCard, and even Nvidia. Think of it as collecting rent from stocks you already own. With $39 billion in assets, investors are catching on to this income secret. But here's what most people miss. JEPI isn't just about high yield. Its unique strategy actually helps reduce volatility in your portfolio, acting like a shock absorber during market turbulence. For anyone who needs income now, not years from now, JEPI is like finding a golden ticket in your chocolate bar. Why combine? These ETFs. Harry, a typical 30-year-old investor, knows that successful dividend investing isn't about chasing the highest yield. It's about creating the right combination. By strategically mixing these ETFs, Harry gets immediate income, JEPI, long-term growth, SCHD, sector diversification, RDIV, and inflation protection, XLE, all in one simple strategy. Let's look at how 3 different combinations perform for Harry's income investing goals. Strategy number 1, Monthly Income Maximizer. Our first strategy is the Monthly Income Maximizer, designed for investors who need immediate income without depleting principal. Here's the allocation. 70% JEPI, for maximum monthly income, 7.98% yield. 30% SCHD, for stability and dividend growth, 3.91% yield. This creates a blended yield of around 6.76% while keeping expenses low at just 0.26%. Let's see what happens when Harry invests $10,000 initially and adds $500 monthly. Using our calculator with real May 2025 data, after 5 years, Harry's portfolio quietly builds to $50,771. But check this out. It's already generating $3,432 in annual dividends. That's $286 every single month without touching the principal. By year 10, the portfolio has exploded to $109,979, paying out $7,433 annually. That's $619 monthly in passive income. Fast forward to year 30, and Harry is sitting on $765,468 with an incredible $51,738. Annual dividend stream. That's $4,311 flowing into his account monthly, potentially replacing a full-time income. The best part? JEPI pays monthly, so you're getting real cash flow 12 times a year, not quarterly like most dividends. If you're serious about building income like this, hit that like button right now. It tells YouTube to show this to other investors who need this information. Let me quickly explain how these projections work. I'm using monthly compounding with a weighted average return based on each ETF's historical performance and current yield. Every month, Harry's balance grows by the monthly rate, then adds his $500 contribution. Dividends are calculated by multiplying the total portfolio by the blended yield. This is exactly how compound growth works in real dividend portfolios. And I'm just getting started because the next strategy takes this to another level entirely, especially at the 30-year mark. Strategy number 2, Balanced Growth and Income. Our second strategy is the Balanced Growth and Income portfolio, providing the perfect blend of current income and long-term appreciation. Here's the allocation. 25% SCHD, core dividend growth, 3.91% yield. 25% RDIV, financial sector exposure, 4.08% yield. 25% XLE, energy sector growth potential, 3.39% yield. 25% JEPI, enhanced monthly income, 7.98% yield. This creates a 4.84% blended yield with diversification across multiple sectors. Harry starts with the same $10,000 and adds $500 monthly. By year 5, his portfolio reaches $52,356, generating $2,534 annual dividends, $211 monthly. At this stage, he's seeing slightly better performance than Strategy 1. At year 10, things get interesting. The portfolio grows to $116,789 with $5,653 annual dividends, $471 monthly. The balanced approach is pulling ahead of our income-focused strategy. The real magic happens at year 30. Harry's sitting on $935,800, about $170,000 more than Strategy 1, while still generating $45,293 in annual dividends, $3,774 monthly. What's happening? The growth components, XLE and RDIV, are driving superior long-term returns while still maintaining solid income. It's like having your cake and eating it too. Remember, past performance doesn't guarantee future results, but this balanced approach has historically delivered both substantial income and impressive capital appreciation. Strategy number 3, Dividend Growth Accelerator. Our third and final strategy is what I call the Dividend Growth Accelerator, focused on maximizing long-term dividend growth and total returns. Here's the allocation: 60% SCHD, maximum dividend growth potential, 3.91% yield; 40% XLE, energy sector growth driver, 3.39% yield. This creates a 3.70% starting yield, lower than our other strategies, but with massive growth potential. Again, Harry starts with $10,000 and adds $500 monthly. After 5 years, his portfolio is worth $54,003 with just $1,999 in annual dividends, $167 monthly. On the surface, this looks disappointing compared to our other strategies for income. At year 10, he's at $124,125 with $4,595 in annual dividends, $383 monthly. Still trailing the other strategies for immediate income. But then something remarkable happens over the next 20 years. By year 30, Harry's portfolio explodes to $1,149,985. Over $214,000 more than Strategy 2 and nearly $385,000 more than Strategy 1. It's generating $42,572 in annual dividends, $3,548 monthly. While the yield is slightly lower, the superior total return means Harry ends up with substantially more wealth. And here's the hidden advantage. SCHD has consistently grown its dividend over time, increasing the yield on cost year after year. This strategy takes patience. The income doesn't look impressive in the early years. But for investors with a long time horizon, it delivers truly life-changing results with an incredible 505.26% return on investment. Let's compare all three strategies side by side. Monthly income. Maximizer, highest immediate yield, 6.76%. Monthly income stream from day one. Lowest total portfolio value at 30 years, $765,468. Highest annual income at 30 years, $51,738. Total return of 302.88%. Balanced growth and income. Moderate yield, 4.84%. Excellent diversification across sectors. Middle total portfolio value at 30 years, $935,800. Strong annual income at 30 years, $45,293. Total return of 392.53%. Dividend Growth Accelerator. Lowest initial yield, 3.70%. Highest total portfolio value at 30 years, $1,149,985. Solid annual income at 30 years, $42,572. Best capital appreciation potential. Spectacular total return of 505.26%. The key takeaway? Your best strategy depends entirely on your timeline and priorities. Need immediate income? The monthly income maximizer delivers from day one. Want balance? The balanced growth and income strategy offers the best of both worlds. Have time on your side? The Dividend Growth Accelerator builds substantial wealth for future income. Wait, don't invest just yet. These 4 mistakes could completely ruin everything we just built. Tip number 1. Reinvest every single dividend. This isn't optional, it's the engine behind Harry's $4,300 month income. Without reinvesting, you lose the compounding effect that multiplies your portfolio over time. Tip number 2. Use tax-advantaged accounts. If you're holding these ETFs in a regular brokerage account, you could be handing thousands to the IRS. A Roth IRA or 401k. That's like giving your dividends a tax-free raise. Tip number 3, rebalance once a year. As some ETFs grow faster than others, your mix will drift. Rebalancing puts your portfolio back on track, like adjusting your sails to keep moving toward financial independence. Tip number 4, match your strategy to your timeline. If you're 25, lean toward growth. If you're retiring in 5 years, prioritize income. Picking the wrong mix can cost you hundreds of thousands in the long run. These 4 dividend ETF strategies combine simplicity with serious results. Starting with $10,000 and adding $500 monthly, Harry built a portfolio generating over $4,300 in monthly income after 30 years.